We've got more applications we want to take a look at in Module 12.2. Particularly, we're going to start off with talking about continuous income streams. Look at how that relates to the concept of future values, and then talk about both consumer and producer surplus. So let's start off with a situation where we assume a relative establishes a trust. And in this case, a trust that's going to pay you $2,000 a year for a period of 10 years. So at the end of that 10 years, the trust will have paid you 10 times 2,000 or $20,000. So let's look at this problem. That's a relatively simple problem to approach, but let's look at this from a graphical perspective, what we're saying. So in this case, what we have is $2,000 being paid to us every year. So if we looked at x equals 2, so after 2 years, we would have gotten $2,000 the first year, $2,000 the second year, so a total of $4,000. We could look at how much we made after 6 years, 8 years, or in this case, what we're really interested in is after 10 years. So if we consider the horizontal distance here, that's a distance of 10, and the vertical distance is a distance of 2,000. So if we take 10 times 2,000, we get the $20,000 that we came up with when we initially approached this problem. So in finding the total income, over a 10-year period, essentially what we did is just found the area between the curve and the x-axis. So just thinking through this practically, $2,000 each for each of 10 years gives us $20,000. Here we have 10 times 2,000 gives us $20,000. So when we're trying to find that total income, really what we're doing is just finding the area under the curve, in this case under a constant income stream. That's predictably $2,000 every year. So the trick becomes that not all income streams are constant. So most income streams, whatever we're earning money from, isn't giving us predictably $2,000, especially if we're talking about business applications. We've got variable income depending on how many units were sold, how much money was spent, that sort of thing. So what this means is we can always calculate the total income for a continuous income stream if f of t is the rate of flow of that income stream. Then the total income produced during the period from t equals a to t equals b can be calculated as the integral from a to b of f of t, that function that describes our continuous income stream, dt. So in the case above, this line represents y equals 2,000. So really, in order to take 10 times 2,000, if we want to do this in applying the definition below, this would be integrating from 0 to 10, 2,000 dt. So for a constant, it's simpler than that. We can just take length times width and find the area of that rectangular region. But for more complicated functions, we'll have to integrate that given function, since our cost is variable, and just integrate it over whatever time interval we're interested in considering.